Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I'm going to be discussing what happened in the economy and markets in the first quarter of 2025. Taking a look at the returns here, you might be surprised to see that nearly every asset class was actually up in the first quarter. The two outliers, of course, are U.S. large cap stocks and U.S. small cap stocks. And if it felt worse than a 4.5% decline in the market to you, that's because we actually had a new high in the equity market on February 19th, and then prices declined 10% from that peak to close down 4.5% for the quarter. So it was a pretty bumpy ride the last 6 weeks of the quarter. International markets had a pretty strong first quarter. We've been talking for a long time about how expensive the US market has been and how attractive international company valuations have been, and that really starts to play out during market stress. When valuations in the US came down because the price came down, investors fled US markets in favor of international equities. Interest rates fell as a flight to safety pushed up demand and prices of treasuries, and even high yield bonds had a positive return. Spreads widened a bit, but the high interest rate offset the price declines. Real assets also were up as expectations for renewed inflation ticked up. REITs benefited from a decline in yields, and somewhat counterintuitively, commodities were up across the board. Of course, the volatility in the US markets was driven by underlying uncertainty in the outlook for the economy. So, this top chart on the left looks at some economic indicators and where expectations were in September versus where they ended the first quarter. So, economic growth or GDP is now expected to be lower, while inflation and interest rates are expected to be higher for the year, mostly due to tariffs and trade policy. If you look at the chart just below that, you can see those top names in the S&P 500 that have been referred to as Magnificent Seven really pulled down the entire index, with names that have a big weight in the index down considerably. On the far right-hand side of that same chart, you can see the S&P 500 Equal Weight Index, which weights every stock on the index equally, and that was down only 0.6%. And as I mentioned, international equity markets did well. The chart on the bottom right shows the 11-point spread between the International Developed Index and the S&P 500. Checking in on inflation, you can see prices were up 2.8% in February, and since this went to print, March inflation came in. It was up 2.4%. So still trending in the right direction. It's much too soon to see the inflationary effect of tariffs in the first quarter data. Core inflation, which measures price levels excluding food and energy costs, were higher than the headline number that you usually see in the news, so up 2.8% in March. The reason this metric is interesting is that commodity prices move around a lot. So when you strip out the impact of those volatile prices in food and energy, you can see that the prices on everything else are still rising a little bit faster. So sitting here early in the second quarter, what we don't have is the right side of this chart going through the next 12 months. And that's where the uncertainty lies. Investors are worried about what happens to this inflation number if and when broad-based tariffs drive up prices, coupled with a possible tightening of the labor supply due to lower immigration. Because remember, the foreign-born population has been driving a lot of the growth in the labor supply that we've seen. And since population growth is one of the main drivers of economic growth, we could start to see a slowdown due to that variable alone, but it's really too soon to estimate the magnitude of that. So, taken together, all of these concerns really put strain on those companies and sectors that had really high valuations. So, even within the S&P 500, defensive sectors like utilities and healthcare, financials, and consumer staples were actually up for the quarter. And tech companies, consumer discretionary companies, and companies in the communication services sector, which includes companies like Google and Meta, had significant drawdowns. Down below, you can see small cap companies fared worse than their large cap counterparts, and growth companies underperformed. I want to spend just a moment on this page because we've been talking about the Magnificent Seven over the last 2 years. And while they were down about 15% as a cohort in the first quarter, it's important to remember that these are still profitable companies. Their price was high relative to their earnings, but the earnings outlook is still positive. So we aren't yet talking about an earnings recession. In fact, companies are reporting earnings for the first quarter right now, and they've largely been coming in ahead of expectations. Analysts have actually revised their outlook for earnings growth in 2025 upward this quarter. So I'm expecting more headline risk as we go on this year and in the coming years, but don't lose sight of what's actually important over the long term, and that's company earnings. We do not think it's prudent to try to time the market. Even if you're successful getting out before a big dip, no one has the skill to time the bottom and get back in before the rebound. Some people have had luck doing this, but it's not a great strategy. So I say that just to point out that historically, when consumer confidence really slides, that has been a turning point for the market. Now, I'm not calling a bottom in equities or even in consumer confidence because things certainly could get worse from here. But if you look at any of these troughs in consumer confidence over the last 50 years, the market has had really good returns in the 12 months following. Now, if we do go into recession, if we start to see unemployment tick up meaningfully, or if we start to see inflation rise and trend back toward 3% or higher, people will probably feel worse in that scenario and stocks could continue to go down. I'm just pointing out that you should not let your emotions drive your investing because when people are feeling really good, that's when you tend to see negative returns over the next 12 months. And when they're feeling really pessimistic about things, that's when you see those big returns. So don't try to time things based on how you're feeling about politics or the economy or the market. If we do have an economic downturn, the market will bounce back long before the economy does. One way to help smooth the volatility in your portfolio is to look at asset classes outside of US equity. And I just want to say that even with a good performance in the first quarter, international companies are still cheap. They're cheap relative to the US and they're still at a bigger discount than their historical average discount over the last 20 years. So still a fine place to look for diversification. These cycles of outperformance and underperformance with the US tend to come in years, not months. We have certainly seen some head fakes over the last few years when international equity picked up some steam and then the US market surged ahead. That certainly could happen. Don't go and dump all of US equity. But if you aren't diversified, it is a good time to look outside of the US. Fixed income did exactly what it needed to do in the first quarter. Core bonds returned nearly 3% in the quarter, and even with interest rates down a bit since December, these yields are still pretty attractive. So if you're feeling nervous, it's not a bad idea to add a bit of fixed income to your portfolio. I really like this chart because it helps keep the focus on the role of stocks and bonds in a long-term portfolio. So if you look at the data going back to 1950, there have been years where the stock market was down as much as 37% and years where it has been up as much as 52%. Bonds also can have negative returns over a 1-year period. But if your time horizon is only 5 years, there still have been periods where stocks have been down over this time frame as well as bonds. But look at that 60-40 portfolio. Going back to 1950, there has not been a 5-year stretch where if you invested money and didn't touch it for 5 years, you would have lost money. And the longer the time horizon, the better the outcomes. And even if you are in or close to retirement, you likely still have at least a 10-year horizon, more likely 20 or even 30 more years depending on your goals. Remember, money that you save to get you through retirement has to outlast inflation. You want to preserve that purchasing power. And the best way to do that is to keep some equity in your portfolio. So if you're feeling nervous about the current environment, I get it. There's a lot going on and the market has been moving. But when it comes to your investments, try to stay disciplined and resist the urge to hold cash because cash does not beat inflation over time. I'll wrap up with a quick recap on real assets. It makes sense that gold was up in the first quarter. Globally, when investors feel nervous, they buy gold. It was a bit of a head scratcher to me that energy was up 11%. It seems if there will be less trade, fewer ships or planes crossing the oceans with stuff, that there would be less energy needed. And in fact, since the end of the quarter, energy is down pretty big. Nevertheless, the first quarter saw positive returns across the commodity complex. REITs also had positive returns driven by fallen interest rates. You can see some of those sectors are more rate sensitive, some are more sensitive to the headlines or the economy, like data centers and lodging. But overall, REITs were up, and they don't move exactly in line with stocks or bonds, which is why they play a nice diversification role in the portfolio. And with that, I will just remind you that if you have any concerns or want to talk to your relationship manager about your financial goals, please reach out to us.